Good afternoon, everybody. Welcome to our webcast on selecting an option strategy. I'm Connie Hill, product manager and education coach here at Schwab Trading. Happy that you've climbed aboard today. You know, many times you guys have a lot of questions, and we like to answer your questions, especially if it helps you understand better how to trade a strategy. Now, today we're going to have the opportunity for me to answer one particular question that one of you had in our survey from last week, and I'm willing to bet there are a lot of you that are also interested in that topic. And the topic is, the question was, how do I identify if I need to try to salvage my trade now? And what do I do? Okay, so we will be addressing that topic in just a few minutes. Now, I am joined in the chat by Barb Armstrong. I'm glad Barb's here. Hopefully the fires from our last session have settled down, and happy to have all of you here as well. Now, if you have questions, go ahead and chat them in. I'll keep an eye on the chat. Barb will have my back. If there's something that you chat in that maybe she can handle for me, she'll pick that up. But don't hesitate to give us your questions. Now, those of you that are listening to this on the recording, and I know there are lots of you that do, when you have a question, go ahead and put them in the comments section in YouTube. I go back and look at those every day, every trading day, make sure we get your question answered as well. Now, I hope you're following us on X. I'm Connie Hill CS. Barb is Barb Armstrong CS, and we'll post educational content, things we're noticing in the charts and the markets that we think might be helpful to you. We'll go ahead and post about it. So give each of us a follow. Let's go through our disclosures and we'll lay out our agenda for today. Options carry a high level of risk and are not suitable for all investors. What we talk about today should be considered informational and educational. Do not consider it a recommendation of any sort. We will be using the Paper Money software application. It's for educational purposes. I think it's a fantastic tool to try out new to you strategies, right? Do them in a paper environment with market data that simulates what's going on in the market. Spread trading must be done in a margin account. Multiple leg option strategies will have multiple transaction costs. Past performance of any security or strategy does not guarantee future results or success. One thing that's different in the Paper Money account is that short options can be assigned. Well, I take that back. Short options are not assigned early in the Paper Money. That's not the same thing as a live account. In a live account, you certainly can be assigned early. So we always like to make you aware of the distinction there. Now, just going to put in a little plug for some of our workshops coming up. Pretty soon, we're going to be down in Scottsdale, sunny and warm. You might want to go sunny and warm somewhere if you're in the freezing cold. That might be a nice one for you. Detroit might be another option for you in April. Those of you that are maybe a little bit more advanced traders, ready for a little bit more meat, might be interested in the Chicago advanced option strategies. We don't do the advanced option strategies as often, and so if you find one that you think might be helpful to you or close to you, go ahead and sign up as soon as you think you can make it, because they do fill up quickly and then it's shut down. You can't register. Okay, so keep that in mind. Now, typically what we're going to do is just take a look at the market conditions, look at what happened today. It looked like we had a little bit of a rally going into the close here. Talk about maybe what option strategies might benefit from the current market conditions. And then we're always going to look at a lot of examples here in the class, examples of new trades, as well as following up on our previous trades and kind of talking through it. Today, we're going to do that with one of the trades that we put on last week. Now, just kind of as a quick look here, we'll come back. These are the main strategies that we focus on in this class. And so some of them are very bullish to sort of bullish in our bullish column. On the bearish column, they are very bearish, like a synthetic short stock position would be very bearish versus sort of bearish, like on, say, a short call vertical. And then we have some neutral strategies. And so we'll identify different stocks doing different things that maybe this strategy might work out well for that particular stock. All right, now let's go out and let's answer the question that one of you posed last week. Now, I appreciate you filling out the survey. As coaches, we always appreciate it when you take the time to do that. And so we're going to address this question. I'm going to read it to you. what somebody submitted in the survey last week. They said, "I like to learn more about how to salvage a trade if it turns bad." Has anybody ever had a strategy or a trade turn bad on you? Not doing what you thought it was going to do? Yeah, it happens all the time, doesn't it? How do we identify when to start making the change? All right, it's a very good question. Let's start out here by looking at a couple of our trades from last week. Last week, I wanted to do a comparison. Some of you were interested in having some discussion about long verticals versus short verticals. Well, it might be more advantageous to do a short vertical than a long vertical. So we're going to follow up on a couple of those particular trades. So if we come over here to the monitor tab, and we come here to, we're going to start with we'll do this one, MSTR. On this particular one, when we were putting the trade in last week, I made a mistake on the trade. I put it as a buy vertical as opposed to a sell vertical, even though we talked through all the logic of a sell vertical. So since we put the trade in when the market was closed, I went ahead and canceled it and put it in the right way so that we could follow up on it. And so here we have a short put vertical, which would be a bullish trade. Or I take that back. This is going to be a long vertical, and our short call vertical is here. Let's go take a look. I want you to notice our short legs. We've got a 310 put that is short and a 360 call that is short. And that's the direction we would like to see the stock go. These are typically a trade you wouldn't do together. Typically, you might just pick the put spread or the call spread, as opposed to doing both of them. I did both of them so that we could have a little bit of a comparison here. So let's look at this, and then we will go out and take a look at the markets. I'm going to drill in here, kind of zoom in, and I marked up on my chart what the trade is so that I can keep track of it. I don't know if any of you do this, but I think that's a helpful thing to do with your drawing tools. We looked at this trade technically on this day. Okay, this was the 11th when we had our class, but the trades went in on the next day. Okay, so this is the day that we got into the trade. So up here, I'm saying, hey, we've got a short call vertical. It's a 360, 370. And so we need the stock to do what? We want it to stay below there, below that 370. Here's our 310, a long put vertical. Now this is, long put vertical. And really, they haven't moved a whole ton yet. Okay. Let's see, on both of these trades, we're down about 157. We've got a whole month left in both of them. We're just going to continue to let them work. Neither one of them have, not either one, but the stock itself hasn't really made something that might change your mind. Like, hasn't broken through, a hard level of resistance or a hard level of support are the types of things we'll look for. Hasn't put in a higher high. Okay, so if it doesn't do those things, we're just going to let it work, even though we might be down a little bit. Now, let's just look and see what the markets have done in a little bit. I don't want to spend a ton of time here, but I do want to spend a little bit of time. And would you look at that? And as the market rallied, it put in a brand new high, 61.29. It was interesting. It wasn't up that high until just the very end of the market. Okay. Some of you have said, are we, before maybe we had this breakthrough on Thursday, are we bearish now because we were having some lower highs? But it was kind of the price was within this triangle. And so as long as the stock is kind of within the triangle, we're waiting for it to tell us which direction it really wants to go, which resistance in this case. Is it going to break out of resistance, or is it going to break support? Which way is it going to go? So on Thursday, it kind of told us which way it wanted to go. Okay. And then today, putting in a new high. Now, earlier today, the VIX was up a little bit, and I'm going to say most of the indices were down. I don't want to say all of them, because all of them, they may be unified at the end of the day, but during the day, they were mostly weak. I think the Russell 2000 was up a little bit. So here's our VIX. That gives us, it's kind of our gauge for fear, right? And as we look at the gauge for fear, if the VIX is high and going up, that's usually when we see some panicky things in the market. People wanting to maybe be protective of their positions. They might also maybe be stopping themselves out of a trade. Those types of things when the VIX pops and goes higher. So today it was up a little bit, not a ton. But then as the market started rallying here at the end of the day, then that started to pull back. And it looks like, oh, it's looking like it gave us kind of a flat there, not up or down a whole lot at all. Okay, but we can see it in the candle. Yeah, it gapped up, ran a little bit, and then fell the rest of the day. So knowing that the SPX was on a new high, let's take a look at the NASDAQ. Let's see what it did. Whoa, it as well had another brand new high. Right here at the closing, we see this long shadow. The price came clear down here, and then at the end of the day, as the markets rallied, I don't know what the news was because it happened pretty quickly. It started to rally. It put in a new high. So generally speaking, we're probably going to be looking more at bullish type scenarios than the bearish ones. Now, you may have a bearish one pop up on you at some point. Doesn't necessarily mean that you might want to follow it. Now, as I come back here to our different strategies that we might consider doing, in your mind, you might have an idea of, okay, now that we've looked at the volatility, we've looked at new highs on the indexes, which strategies might you be more inclined to pursue? Now, those of you that maybe know all of these bullish strategies, you might have a good feel for which one you might go for. If you're somebody that maybe knows two of the strategies, well, you're going to be a little bit more limited in maybe what you choose. But just because you might choose something that somebody else chooses something different in this list, it doesn't mean one person's wrong or one person's off. Really, sometimes even if you know all of these strategies really good, it's hard to know which one might work the best because we just don't know. And so some people might be more inclined to be more conservative with their approach. Some people might be inclined to be more aggressive with their approach. And it also depends on the stock itself. Now, I want to, BJ said, new highs are not bearish. Absolutely. Yeah. Let's come back here and I want to look at the other trade that we put on last week. It was on FCX. And I'm going to bring up the chart here so we can look at it. It had been downward trending, had this nice white line as a diagonal resistance line. And it was something we were just kind of watching for a little bit. And on the day that we looked at getting into this trade on the 11th, it had bounced down off that diagonal resistance. So our trade went in the next trading day. Turns out it was a little bit more of a bullish day. And then what happened Thursday? Boom, it broke right through that resistance. Now, some of you might use a break of diagonal resistance as an entry point for something bullish. You certainly could, okay, if it breaks that resistance. You don't necessarily need to have high volume on breaking diagonal resistance. So those of you that are like, well, maybe it's okay. On that day, it actually did have extra volume, which just kind of gives us a little bit of an idea that a lot of the market was in there. Maybe institutions and others were also taking positions on this. And then a little bit of a pullback here today. But what does today's candle look like? Does it look like a bullish candle or a bearish candle to you, those of you that do know candlesticks? We would probably call this a hammer, okay? It's got a little teeny body and a long shadow, which is kind of like what your hammer looks like. You pull it out of the toolbox. Yeah, it kind of looks like that. And it's an indication that basically the bears pushed it down here and the bulls chased it back up. And the next day, then it's likely to be a bullish day. So we've kind of got a couple of things indicating perhaps maybe this one is going the opposite of what we expected it to do. Okay, you can see here, I've got a 36.34 long put vertical. So look like it's going to be heading that direction anytime soon. Not looking like it right now, is it? The other one was a short call vertical. So that one's a little bit more conservative. And on that, man, it is looking like on Friday at some point it was above our short leg. And on Friday as well, and this is true with Thursday, it put in a new high. So we have this high up here is significantly higher than the previous high. So we have a one higher high for sure. And tomorrow may be a higher low. We won't know until it starts trading tomorrow when we see what the market does. We have that reversal potential of a candlestick. And so you might be going, man, is that enough evidence that maybe we should consider getting out of this trade? Now, the first trade we looked at, we've got plenty of time and it hasn't really formed a new high, a new low. It hasn't broken, some resistance or support like what we're seeing here. And so those could be the things that somebody might look for to say, should we change the trade? Should I try to salvage the trade? Should I change my opinion? Is this now a dog and I got in when it was a cat? Has it totally changed? Now, we may have differing opinions on that, but those are some things that you can look for. I'm going to say we're in a position today that, the stock trend has changed. It's put in a higher high, probably put in a higher low. We'll see tomorrow. And the break of resistance, this diagonal resistance is really the big one. All right. And on that day, that's when it put in that higher high. So what are we going to do here? We've got two bearish trades. Let's see. I want to look here. John says, when the stock hits a new high, does that mean it is more likely than not to keep going up? Well, it's an indication that the trend is changing. A trend, say an uptrend, is where we have a higher high and a higher low. So we get the first part of that, a higher high, that could be an early indication, that the trend is changing. Now, it's not guaranteed that it's going to go up tomorrow, even though we have a reversal candle, even though the SPX and the NDX put in new highs today, it doesn't prove anything for tomorrow. So some people might wait for more evidence. Some people might say, well, let me see what it does tomorrow and see if it really looks like it is reversing. That's completely fine. You and I aren't going to be hanging out tomorrow, so we're making some decisions based on what the chart looks like right now. Okay. We talked, it was either 2 or 3 weeks ago, we talked about basically reversing a trade. We call it a change of polarity, which basically means if you were negative, now you're positive. If you were positive, now you're negative. Okay, just kind of switching that up. And so we're going to do that with both of these trades. Let's see, Moxie says, it looks like an inverse head and shoulders pattern. Ooh, could we look at that? Yeah, let's take a quick look at that. If my drawing tools will cooperate here, there we go. Let's do it. This could be, oh, that's not very thick, is it? Let's make it a little bit thicker. That could be the head down here. Somebody standing upside down on their head. This could be the shoulder. And then you have the dip that goes lower. And then you have the other shoulder. I like that. Thank you for pointing that out, Moxie. Appreciate that. What does that mean, an inverse head and shoulders? Well, it's a reversal price pattern. That could be an additional piece of information that says, maybe this thing is changing. On a reversal price pattern, we come up here and we look at this kind of, I drew a line there, but I really am going to redraw it because what we want to do is identify what we call the neckline. And because I do not draw lines very straight, we're going to use the drawing line here. And so we might look at the neckline. It can be slanted, it can be flat. It can be slanted in either direction if we want, okay? That is the neckline, and Thursday it broke the neckline, which somebody's saying, I see a reversal price pattern there. Yeah, they may use that as an entry to a bullish trade rather than a bearish trade, okay? Love these questions. You guys are doing great here. All right, let's see what can we do with our trades. let's kind of clean up those marks on the chart. Well, if we are short the 40, let's come over here to our monitor tab now. If we're short the 40, let's go so we can really see these. And let me collapse this. Here's our FCX here, okay? 40.42 is what we have here on this call spread. Well, a short call typically is more bearish or sideways if you're selling it like a covered call. But in this scenario, this particular one is actually the one that is, let's see here. We got 94 cents. Let's see if this is the right direction here. Just going to go back and look at our chart. Yeah, we're looking for it to stay below that 42, and then we've got, or 40 rather, and then 42 is our hedge leg. We might just say, let's buy back our hedge leg, or keep the short leg rather, and buy back our long call. Because see, the long call, actually this looks like the long call is, I wonder if this one is a little bit not the right way. Let's see, if we collected 46 cents on it, now it's worth 79. Yeah, it's showing I'm on the right line here. We're down about 132 on it, okay? So we're gonna say, all right, we're gonna change the trade. We're gonna say it's doing something different than what we expected it to do. And it's not that we're skittish on it, okay? That's not the case at all. We're seeing definite things on the chart that indicate trend looks to be changing on us. Okay, so here on the calls, we're going to buy back the call leg. And I may have, I think I may have marked it incorrectly on my chart here. Okay, that is what could be throwing us off here. I was thinking, let's see, initially when we got in here, we're looking for it to go down. So we have a 36.34 on our long put vertical. As we come back here, let's see here. Yeah, because I guess this one's down 224. I guess it's down the most. Now we have more contracts in it for position sizing. But let's do this. Let's keep our short put and let's sell this long put. Okay, short puts are what? Bullish. Do we expect this short put to, over the next 31 days, to stay above, say, 36? Well, in actuality, we'd love for it to go up quite a bit. Okay, we'd love for it to do that. So let's go ahead. We're not going to roll it. Sometimes that question comes up, what about rolling something? Typically, you might roll something in a couple of scenarios. One, you kind of like the trade and you want to extend the trade. Hasn't quite made the move that you wanted it to. Maybe it's moved part of the way there and you're running out of time. And so you might roll it to give yourself more time for the stock to complete the move that you thought it was going to do. Okay. In this scenario, we don't want to extend it. Okay. It's not doing what we expected it to do. All right. So let's go here. We're going to keep this short put and we're just going to buy back, or we're just going to sell rather, the long leg here. So make sure I get the right one, 38. Let me get this over out of the way. Get it on our 38. Going to buy it back we're going to hope to get it tomorrow for 92 cents. All right, that's our midpoint price. In the morning, I'll have to check it, make sure it really does it, okay? And we're going to kind of need the stock to stay elevated, right? Stay up. And if it can go up a little bit further and lock in maybe some of that premium that we sold, not intending for that to be our main leg, it was just kind of our hedge leg, okay? But now we're going to say, all right, you have to do the heavy lifting for us, okay? And on the put spread, let's collapse this guy. Well, we can't collapse it. On our 40 call and 42 call spread, well, we're going to have to buy back our short call for a loss, but we're going to hang on to the long call, and we're going to hope that the stock makes a lot of ground, that it continues to go up. This is the leg that's going to have to do the heavy lifting, even though initially we put it in as our hedge leg. Okay, so that's going to be our 42. So we're just going to close the 42. Now, any questions on that? Any questions? Going back here to the chart, we're totally changing the trade because of what we're seeing on the chart. Now, a couple of points that you might want to take some notes on. Number one, if there is not very much time left on the trade, say you've got 5 days, 7 days, that might not be enough time for the leg that's left to do the heavy lifting. Might not be enough time. If that is the case, then you might decide to close the trade down and say, gee, there just isn't quite enough time for it to really make a move. This one has 31 days worth of time. So there's plenty of time for it to kind of flip and try to go the other direction. Okay. Let's see here. Oh, Lakshmi had something, but I think you took it back. All right. All right. I think we've got all the questions here. If not, chat it in again, but I think we're catching them here along the way. All right. Now, we're kind of coming towards the end of earnings season. We do have some earnings trades coming up. Some of them might be, some of you, I should say, like to trade earnings. Some of you don't. Okay. We have selected here, I've got 4 trades, 2 with earnings, 2 without earnings. Okay. And one of the trades for earnings I put on right before our class happened, right before we started our class. So let me show you that and what we're looking at here. So on this one, let's see here. It is ADI. Okay. We actually put on 2 spreads, a short put vertical and a short call vertical, with the idea that we're hoping that what we've sold is beyond the market maker move. Okay, so let's take a look at it here. Let's bring up ADI. There we go. Now, ADI looks like that tonight or tomorrow morning. Yeah, this one's tomorrow morning, so there's nothing for us to see yet. But to get in on an earnings trade, you have to do it before the market closes tonight, because they're going to announce in the morning before the market opens. Now, many of you maybe already have this little script that shows and graphs what the market maker is pricing into the move. Okay, and that's a decent size move that we're looking at here. All right, so it's saying 230 and change and 209 and change, so maybe say almost to 210. That is what is priced into the shorter dated at the money options. Okay, does it mean the stock has to go there upon the news? It doesn't. Does it mean the stock won't move beyond there? No, it doesn't mean that either, because we honestly don't know. So what we decided to do here is to do a spread beyond our market maker move. Okay, so something maybe a little higher than 230. Let's see what it was when I got in here. Looks like it was about 230, and down here was about 208. Now it's about 210. So it's gone just a little bit wider than what I initially put on the trade. Now the strike prices that we've selected here, we can just kind of go back. On the put side, we are short 205, and our hedge leg is going to be the 202.50 put. Okay, that's going to be beyond that 210 area where the market maker move was. And on the call side of things, we are short the 235, and then our hedge leg here is the 237.50. So 235 is kind of up and beyond where that market maker move is. Okay, so the best case scenario for this trade, and it expires Friday. All right, the best case scenario is the news comes out, implied volatility collapses. We cashed in on, or we sold some premium with those trades. And I'm going to go back to the trade tab here. Those are the ones that we have. Implied volatility priced into those options that expire Friday is about 72% implied volatility. So when that news comes out, that's when we're expecting the implied volatility to come crushing out. It'll come out of all options on the chain, right? It's not just going to be the options you picked. It's like every option on the chain. And that's good because we sold the premium. Well, no, it's up high, a little bit juicier, with the expectation that we gave ourselves quite a bit of leeway on the trade. Now, does everybody have, and maybe I don't have it on here. Looks like I don't, so I'll have to put it in my notes. I typically on my screen have a spread, or a script rather, for the market maker move. Okay, market maker move we can see right here. This really is 3 M's, okay? It's like 2 M's on top and 1 M on the bottom for the market maker move, plus or minus $10.53. Could be up, could be down. We don't know. We don't know which way it's going to go. And we all get to find out together tomorrow morning, okay? So this is one if you are interested in kind of putting it in your paper money account so you can see what happens. This one actually is too late. You can't do that one. I've got another trade you'll be able to do that on. But if you just want to take some notes as far as what our trade is, then you can kind of see what it might be. Now, because it's these options that are going to expire in 3 days, we're not planning to be in the trade all that long. Many times we will exit this trade separately. Now, by options expiration, is it possible for the stock to be at, it's not possible, I should say, for the stock to be at 2 different strike prices, is it? It just isn't. It's going to be one direction or the other. And so in this scenario, it could be that, let's say the stock pops up, okay? We don't know if it's going to, but let's suppose it goes up. Well, our put spread could be in pretty good shape and our call spread might be a little under pressure. Okay, maybe the value of this spread gets a little bit higher. We collected 46 cents on it. And so, yeah, it may go higher and we may end up maybe closing out that leg separately from the put leg. And the put leg, we might say, hey, we're going to try to let it drain as much time value as possible. We may choose to close it up early just to take away some risk off the table, lock in some profits without waiting for maybe news to come by and possibly change what the stock is doing. Okay, so it's technically an iron condor, but we're putting it on as 2 verticals and kind of treating them a little bit separately from each other. Okay, even though, yeah, both of these together make an iron condor. All right, we will be watching that one. Let's see, it's down here. Okay, let me look here real quick. How many of you have already subscribed to our Trader Talks channel? I know there's a bunch of you that have, which is fantastic. If you haven't, go ahead and click on that little button in the bottom right hand that looks like YouTube, but blue, a blue logo. You only need to do this once. If you've already subscribed and you click on it again, it'll unsubscribe you. So you only want to do it once. And then it makes it really easy for you to find our content. Maybe you're interested in seeing, what those trades look like last week. Then being on our YouTube channel is going to help you find that. Okay. When you're on Trader Talks, you'll see some of the classes that just were posted here recently. You see what's coming up next. In our case, we're actually the last class of the day. So the next one's going to be tomorrow morning, right bright and early at the opening bell, Trader Talk in Today's Markets. And then we have some links to some classes that have been really popular. And then, of course, you can get your playlist. If you're trying to keep with a particular track, somebody's series that they're teaching, selecting an option strategy, you can go to that playlist and play through those various classes that have already been posted. Okay? So just helps you find our content a lot easier. I mentioned at the beginning this idea of hitting a workshop. How do you find the workshop? Come over here to the Learn menu. And on the Learn menu, if I go back a page, we're going to click on Schwab Coaching. Okay? So here's Schwab Coaching from the Learn menu. And then to see when these events are, the in-person events, click on that calendar, and that'll lay all of them out for the whole year. Some that are later in the year are not available to register for yet, but there are lots of them that are. And like I said, as soon as you think you want to maybe go to one of those, go ahead and save your spot, okay? Because once it's full, it's full. And we're having some bigger rooms and bigger crowds that are coming, and they're still filling up pretty quickly. Okay, so we want you to know about that so you can take advantage of it. Now, Chuck says, hey, Connie, I already subscribed to the channel, and I'm a new trader just learning the market. Perfect. You're in the right spot here. You're in the right spot, Chuck. And so, yeah, you'd only want to select on that once so that it doesn't unsubscribe you. All right. That was our earnings trade. It's already in, but we're going to follow up on it next week. Now, let's come back here. Let's do a non-earnings trade. All right. I've got a couple of stocks that have already gone through earnings, and so we're going to look at them. This one is kind of interesting. The one, well, they're all interesting. I think they're all interesting, right? Dutch Brothers, you might have Dutch Brothers around you, coffee shops. Well, apparently on their earnings, they did very well. You can see this huge gap up. Now, when we see a big gap, we look for volume. Did it have a lot of volume that day? Man, it had extra volume. Regular or average volume is about 2.8 million. That day, they had 13.8 million. Okay, traded. So yeah, we're talking lots of buying activity here. And how do we know if it's more buying than selling? It's because the price is up. Now, many times the bottom of the gap acts as support. So a lot of times I'll come in here and just draw a little line right here, whatever the low price is. And I kind of watch it to see, all right, is the stock honoring that $80 area as support? If it is, great, would like to see it. So what we're seeing here today kind of is, we consider this, kind of a gap up, a little pullback on Friday. And then today it looks like, it's bouncing up here. Some might say, well, it's a close above the high of the low day, which technically it is. Or some might see it as just kind of bouncing off this potential support level here around 80. Now, knowing something's already gone through earnings, we know that the premiums shouldn't be quite as juicy in them, right? So on Brothers, yeah, the front week implied volatility is kind of pretty normal, okay? We are going to go out to the March options here. And on this one, we're going to lose those March 21 options. We're looking at, let's see here if this still looks appropriate. I was thinking we might sell the 8250 and buy the 80 as our hedge left, just doing a short put vertical here. Now, if somebody's feeling very directional, they might come over here and do a long call or a long call vertical. If you're like, well, I'm just kind of thinking it's made a big move, but I'm just thinking it's probably going to stay up in that area, maybe not run a whole lot, then somebody with that mentality might say, let's do maybe something a little more conservative, where the stock doesn't have to race a lot, but maybe just stay put in order to be profitable in that trade. So let's go ahead and do it. Now, this is a 36 delta. I will tell you, before class started, I experimented with the 80 strike price and selling that, but I didn't like the premium that came with it. I do think there's enough open interest here. You can see I've got my open interest column and just kind of looking at the volume that came in here today. That helps as well, because that's actually quite a bit higher than what it started with, 20 contracts earlier. But the 80 strike price has lots of open interest, so we should be in pretty good shape here as far as doing this. All right, so we're going to leave we're going to leave it here at 80 strike price. It's $2.50 wide, and this is actually bringing in a pretty nice credit here. This is bringing in 90 cents. Okay, that's even higher than what I was looking at here initially. All right, if we have 2.5 minus our 90 cents, we do that. That's going to be what, $1.60. $1.60 is our max theoretical loss. 90 is our max theoretical gain. Right now, this is sitting at about 59% probability of expiring out of the money. It would be nice if it was at 60 or higher. That's what a lot of traders will look for. Okay, so it's close to that. Again, if somebody was more comfortable coming out to the 80, doing the 80, 77.50, you certainly could do that. Now, if we are willing to risk, typically I have in here $1,500 we're willing to risk. Let's just go 1,000 on this, okay? So if $1.60 is our max theoretical loss here, let's take 1,000 and divide that by 160, and that says we could do 6 contracts. Okay, so we are going to do 6 contracts here, and then it's helpful if we put in an exit point for the trade. And we base the exit point. You could do it on a number of things. You could do it on technicals. We're going to do it based on how much of our max theoretical gain do we have. We have a good chunk of it. We're going to get out of the trade and call it quits and be on our way. So we have 90 cents, and let's suppose I like to use 70 a lot. Sometimes we'll use 75 or 80. You know, something that's a higher number. You kind of get used to what you feel comfortable with. Let's go with the 70. And so that means 30% of the 90 cents would be left. So we're going to multiply that by 0.3. That says go buy it back at 27 cents. So we'll do a first trigger sequential, create an opposite order here, and we will go buy it back at 27 cents. And make this good till canceled. And then if we're not around, this and it gets down to this level with a limit trade, it'll go ahead and execute for us, which is awesome. We don't have to try to catch the trade. Now I'm going to throw this down in our option strategies bucket, and we are going to be following up on it next week. Now, we're not in a hurry. We have plenty of time. Our short leg here was going to be, our short leg here is the 82.50. And so where is that? That's down here a little ways, down here where my mouse is. So it can go flat. It can pull back a little bit. Ideally, it'll keep kind of going up or going flat, and we can allow time decay to work in our favor. Okay, so those are the 3 that we're going to be following. Okay, so we have the Dutch Brothers with a short put vertical. We flipped our FCX trades. We had 2 of them. We flipped them because the technical said probably not going to work out for you. And then we also did the trade that I put in before our class started, which is ADI. So we can watch tomorrow morning, see what happens with that particular trade. All right. Well, we talked about our market conditions. You know, implied volatility isn't super high, but in our new strategies, we did go with the selling strategy on that one. And we're looking for maybe the market to maybe continue to grind up a little higher, put in a couple of new highs here at the end of the day. Then we took a look at several examples, which we always like to do. We're going to keep track of these. We'll check on them again next week. We'll see what the progress is. And especially the trade that is done on Friday, ADI, that's when it expires. So I did not see a survey out here today, so I think we're safe there. But if you thought this was helpful information, go ahead and hit the thumbs up button on it. Make sure you're following Barb and I on X, Barb Armstrong CS, Connie Hill CS, and of course, become a subscriber so you can find our content. All right, you guys have a great afternoon. We'll see you at the opening bell tomorrow morning. See you then.